Hello everyone, I'm Daniel Seberg in New York, and welcome to this edition of Money Matters. You know, at one point or another, we all find ourselves with an emergency situation to deal with that can present a real financial hardship. Home damaged or by a storm, or a loved one suddenly very ill, and during these times it's difficult to make the right financial decisions. So it's important to have a game plan in place to protect your money in advance. Joining us this morning with some important advice is More Magazine's features editor, Jennifer Braunschweiger. Jennifer, thanks so much for joining us this morning.
Thanks for having me.
So I'm sure it's human nature in large part. Do you find that many people, though, wait until something bad happens to then ask for that financial advice?
Absolutely. At More, we hear from our readers that people rarely look for financial advice on a whim. They do it because something has changed. They've hit a milestone. Maybe it's a good thing, like a 40th birthday, or they're planning a family. Often, though, it's a bad thing. Somebody has gotten very sick or lost a job. The problem with waiting until something happens to deal with your finances is that then you have a lot of emotions clouding your decision making. So we decided to help people prepare.
Yeah, and you do get blindsided in a sense.
That's right.
if you're not looking around. And as we
Yes.
mentioned, trying to suddenly deal with your money in the middle of a crisis just doesn't work. So let's go over some of the game plans that you've mapped out.
Sure.
Problem number one, you lose your job, as of course thousands of people do every month. What should you do to prepare for this?
That's right. Unemployment is an unfortunate reality of the new economy. Really, the best financial protection you have in this situation is a solid emergency fund. Right now, we're advocating 9 to 12 months of living expenses, liquid and accessible. That can seem like a very high bar to get over. That's why we recommend automating it. Set it up so that every month from your paycheck, a certain amount is automatically going into an account that you reserve just for emergencies. If you feel that a layoff is imminent and you are not where you want to be yet with your emergency savings, you can also investigate loan options. One possibility is a HELOC, a home equity line of credit. The idea is to make that credit accessible while you're still employed. You don't have to use it. You're not trying to go into debt, but it would be much harder to qualify for that loan after you lose your job. You do need at least 20% equity in your home to make that happen, so it's not possible for everybody. A final bit of advice about this is to avoid, if you can, having more than 10% of your portfolio in your company stock. You know, when a company is going through layoffs, that suggests that they are not in good financial shape. You would hate to take the hit in your portfolio at the same time as you lose your income.
Absolutely. So you want to just have that money coming out of your paycheck, almost out of sight, out of mind. Just
exactly
keep having
right.
it go away.
That's right.
Next problem we want to talk about here, and of course no one wants to think about this, but let's just say your partner dies. A horrible thought. But what's the first thing you should have in place for something like this?
Well, your protection with that is life insurance. Now, what our readers ask is, how much life insurance do I need? If it takes 2 incomes in order to pay your mortgage, you both need to be insured. And if one person is staying at home, but childcare would have to be paid for in the event that something happened to one of the partners, then you both need insurance. The way to figure this out is to figure out how much money you spend every year, subtract from that number the amount of money that you're bringing in. What's left over is your shortfall. Then you need to multiply that shortfall by the number of years you think you'll need it. Now, this isn't automatically just until death, because what you need changes. You may pay off your mortgage, you may stop paying for private school for a kid, you may have somebody graduate from college. So that amount does change.
So how often should you reevaluate your life insurance policy? Is it every year? Is that too often?
We recommend about every 3 years, just to make sure that your insurance is keeping up with your lifestyle and with how much money you're spending.
All right, well, let's move on to the next problem. We've seen a few of these lately, natural disasters.
Yeah.
If you're a homeowner, what should you do first?
Well, you know, if it feels like there are more natural disasters happening, it's because there are. Oxfam estimates there are 400 to 500 natural disasters every year right now, compared to 125 in the 80s. So we can't blame this one on the media. There really are more of them. It is a real risk. Your protection is your homeowner's insurance. We ask people to look at their policy and make sure they are covered for replacement value rather than cash value. This means that you will be reimbursed for what it takes to buy something new rather than for the value of, say, your 10-year-old television set.
All right, we've just got under a minute left, Jennifer, but maybe you can talk a little bit about what people should do to track how much their possessions are worth and how to protect these valuable documents too.
Absolutely. You need to know what exactly you have and how much it's worth and stay on top of that. We recommend keeping a video diary or photos, and then don't store it in your house. You can keep those photos on an online site like Shutterfly or Flickr. Do the same for your documents. Scan them. You can email them to yourself if you use a provider like Gmail or Yahoo that has unlimited storage. There are also online vaults where you can store these things securely, but you don't want to have those disappear when your house does.
And I guess ultimately the message is hope for the best, prepare for the worst.
Very nicely put.
All right. Well, Jennifer Braunschweiger from More Magazine, thanks so much for this great advice. We appreciate it.
Thank you.